2 years before the world watched banks collapse, stock markets crash, and millions of people lose everything, one hedge fund was doing something that looked completely insane. While Wall Street celebrated record profits and television experts insisted the economy had entered a new era of endless growth, this fund was quietly spending millions of dollars every single month on a bet that seemed guaranteed to fail. Investors questioned the strategy. Competitors laughed at them. Even some of their own clients wondered if they had lost their minds. They weren't buying stocks. They weren't investing in booming real estate. They were betting that the entire American housing market, the foundation of the global financial system, was about to collapse. For nearly 2 years, they watched money disappear as nothing happened. Then, almost overnight, everything changed. The financial system imploded exactly the way they had predicted, and what had once looked like the worst investment on Wall Street became one of the greatest trades in financial history, generating roughly $20 billion in profits. The real question is not how much money they made. The real question is how they saw a disaster that almost nobody else could see. To understand this incredible story, we have to go back to the early 2000s. After the dot-com crash and September 11th attacks, the Federal Reserve aggressively lowered interest rates to stimulate the economy. Suddenly, borrowing money became incredibly cheap. Banks began approving mortgages at an unprecedented pace, and buying a home quickly became the American dream once again. Home prices climbed year after year, convincing millions of people that real estate was the safest investment imaginable. Television programs celebrated house flipping. Families rushed to buy second and third homes. Builders could construct neighborhoods fast enough to meet demand. Everywhere people looked, prices only seemed to move in one direction, up. Banks loved this environment because every new mortgage meant another opportunity to earn fees. But they had also discovered a new way to make even more money. Instead of keeping mortgages on their own balance sheets, they bundled thousands of loans together into complex financial products called mortgage-backed securities. These packages were then sold to pension funds, insurance companies, investment banks, and institutions around the world. The theory sounded brilliant. Even if a few homeowners stopped making payments, thousands of others would continue paying their mortgages. Diversification would supposedly eliminate most of the risk. Rating agencies agreed, giving many of these securities their highest possible ratings. Investors believed they were buying safe assets with attractive returns. Billions of dollars poured into the market. As demand for mortgage-backed securities exploded, banks faced a new problem. They needed more mortgages to package and sell. That was when lending standards began to collapse. Banks started approving loans for borrowers with poor credit histories, unstable incomes, and little or no money for down payments. Some borrowers didn't even have to verify their income. Others received adjustable rate mortgages with artificially low introductory payments that would rise dramatically just a few years later. These became known as subprime mortgages. To most people, none of this seemed dangerous. As long as home prices kept rising, homeowners who couldn't afford their payments could simply refinance or sell the property for a profit. It looked like a system where everyone won. But beneath the surface, something was quietly breaking. John Paulson wasn't famous at the time. His hedge fund wasn't among Wall Street's giants. Yet he had built a reputation for carefully analyzing situations that others ignored. Rather than trusting headlines or market sentiment, Paulson and his analysts preferred to dig into raw data. Instead of asking whether housing prices would continue rising, they asked a much simpler question: who exactly was borrowing all this money? His team began examining thousands of mortgage files. They found borrowers with multiple mortgages despite modest incomes. They found loans requiring almost no documentation. They found adjustable rate mortgages scheduled to reset to dramatically higher monthly payments within a few years. They found entire neighborhoods where speculative investors owned multiple homes purchased with borrowed money. The deeper they looked, the more alarming the picture became. Many homeowners weren't buying houses because they could afford them. They were buying because they believed prices would keep rising forever. The housing market wasn't being supported by strong household finances. It was being supported by optimism, and optimism can disappear very quickly. Paulson realized something that few others understood. The entire system depended on one critical assumption: home prices could never fall nationwide. If they stopped rising, or worse, began declining, millions of homeowners would suddenly owe more than their homes were worth. Adjustable rate mortgages would become unaffordable. Defaults would rise. Mortgage-backed securities would begin losing value. Banks would suffer enormous losses. One domino would knock over the next. The The problem was obvious. The opportunity was less obvious. How do you profit from the collapse of an entire housing market? Selling a few construction stocks was enough. Paulson needed a way to directly bet against mortgage-backed securities themselves. That's when he discovered a financial instrument that very few investors were using, the credit default swap, commonly called a CDS. A credit default swap worked much like insurance. The buyer paid regular premiums. If the underlying bond continued performing normally, those payments were lost. But the bond defaulted. The seller of the swap would owe enormous compensation. Paulson realized these swaps were astonishingly cheap because almost nobody believed mortgage-backed securities could fail. Banks were eager to sell this insurance. They viewed it as free money. After all, how could highly rated mortgage securities possibly collapse? Paulson began buying massive amounts of protection against the weakest mortgage securities he could find. Every month, millions of dollars left his fund to pay insurance premiums. Nothing happened. Housing prices continued rising. Banks reported record earnings. Financial television celebrated the strength of the economy. Investors began questioning Paulson's strategy. Some wondered whether he had made the biggest mistake of his career. Imagine watching millions disappear month after month while the entire world tells you that you're wrong. That is exactly what happened. For nearly 2 years, Paulson endured criticism while maintaining absolute confidence in his research. He wasn't relying on predictions. He was relying on mathematics. Eventually, the first cracks appeared. Mortgage delinquencies started creeping higher. Small subprime lenders began experiencing financial trouble. Most investors dismissed these events as isolated problems. Paulson didn't. He understood that the weakest borrowers always fail first. If the trend continued, it would spread throughout the entire system. And that is precisely what happened. As adjustable rate mortgages reset to much higher payments, increasing numbers of homeowners stopped paying their loans. Foreclosures accelerated. Banks repossessed homes and flooded the market with inventory. The sudden increase in supply caused home prices to fall. Falling prices trapped even more homeowners. People would plan to sell their homes for a profit, suddenly discovered they owed more than the properties were worth. Many simply walked away. Every foreclosure pushed prices even lower. Every price decline triggered more defaults. The cycle fed itself. Mortgage-backed securities that had once been considered among the safest investments in the world suddenly became impossible to value. Confidence vanished almost overnight. Banks stopped trusting each other. Credit markets froze. Then came 2008. The collapse of Bear Stearns shocked Wall Street. Soon after, Lehman Brothers filed for bankruptcy. Global financial institutions teetered on the edge of failure. Stock markets around the world plunged. Millions lost their jobs. Retirement savings evaporated. Entire economies entered deep recessions. While the financial world descended into chaos, Paulson's credit default swaps exploded in value. The insurance contract that looked worthless for years suddenly became some of the most valuable financial assets in existence. The payouts were extraordinary. By the end of the crisis, Paulson's funds had generated approximately $20 billion in profits for investors, making it one of the most successful trades ever recorded. John Paulson himself earned billions in performance fees and became one of the wealthiest hedge fund managers in history. The remarkable part of this story is that there was no secret information, no classified documents, no insider tips. Everything Paulson discovered was publicly available. The mortgage data existed. The lending standards were visible. The adjustable rate loans were documented. The risks were hiding in plain sight. Most people simply chose not to look closely enough. Markets have an incredible ability to convince participants that whatever is happening today will continue forever. When prices rise long enough, optimism begins to feel like certainty. Questioning the consensus becomes uncomfortable. But history repeatedly shows that the biggest financial bubbles are built on exactly that kind of certainty. The housing crisis wasn't caused by one bad decision. It was created by thousands of small decisions made under the assumption that prices could never fall. Banks assumed homeowners would always pay. Investors assumed rating agencies were correct. Borrowers assumed refinancing would always be available. Everyone trusted the system. Almost nobody questioned its foundation. John Paulson did. His success wasn't about predicting the future with supernatural accuracy. It was about asking difficult questions when nobody else wanted to hear the answers. He examined evidence instead of emotions, data instead of headlines, risk instead of optimism. That approach transformed one of history's greatest financial disasters into one of history's greatest investment victories. Because in the end, fortunes are rarely made by following the crowd. They're made by recognizing when the crowd has stopped asking the most important question of all. What if everyone is wrong?